Okay, we're back. I'm outside, so you might hear some natural noises. And here we're starting at slide 115, looking at asset cash flows. And I just want to mention a couple things here. First, see here we have our three basic approaches to assess the cash flow characteristics. The last two, right, the project cash flow approach and the historical data approach, are going to give you slightly better answers when you're looking for some quantitative information. But these two approaches don't work well with a firm that has a short history, or in the case of when there's been a pretty large change in the asset mix of a firm over time. So we're going to deal with first the intuitive approach here. Now, it turns out there's lots of room to be creative in this approach. If you look at firms that operate in these businesses and see what they're financing, that they're using, you can get a sense of what tends to be going on in terms of, say, how your peers, how managers in a peer group tend to work and view things. And this can be kind of useful in designing the right kind of debt, right? So this just gives you just a basic framework or a layout. And in the context of the application here, the basics for your business, for instance, have to be along these lines of a typical investment. You're trying to assess the type of debt that would align well to the particular investment, right? Very much common sense. Now, let's look at project-specific financing, okay? Basic idea here, straightforward. If you have large standalone projects, you can try to match the debt specifically to those projects' characteristics. Now, if you take a lot of smaller projects on, you're going to find it less costly to finance a portfolio of projects rather than to try to do this, individual financing on a case-by-case basis. Okay. If you think about this in the context of Disney, the duration here is being calculated. We're looking at projected cash flows for the theme park, estimating basically interest rates across the duration might change. And remember, that means cash flows are going to likely drop if interest rates go up. And here we're just estimating an arbitrary terminal value at the end of year 10 as well. Okay, so that's simplistic, but okay, it'll work. So we see our project value in each time period summing to 62 billion. And you divide that by the present value with an 8.46% interest rate. Now, if you wanted to and you thought interest rates are going to rise, then it's probably wise to do that. If we were looking forward from right now, forward 10 years, you should use some basic economic models to arrive at the conclusion that interest rates are going to rise. So I might go with a slightly higher interest rate, but that's okay. Just for purposes of our example, we see a duration of this project is running 18.92 years. So what does perfect debt look like? Now, it's possible to say that you're going to get visitors from a pretty wide global area. You could get some folks from Australia and New Zealand that could possibly enter into the currency mixing, but it's not going to be, a dramatic pull of visitors from everywhere. Okay. If you looked at firm-wide types of financing, you've got the operating cash flow measure, looking at year-to-year capacity of your firm to generate the cash flows. Okay. And if you're looking at it from the point of view of firm value, that reflects your current operating income and the expected growth and the cost of capital. Right. So watch out for that. If you look at Disney as a history, you can see it's changed considerably over time in terms of its business mix. It's been moving increasingly into the broadcasting business, and you see animated movies really a small portion of the overall movie offerings. Here, the firm value is the market value of the equity plus the book value of the debt outstanding in each year. It's a little bit better to use market value of debt, but the book value is a pretty reasonable proxy. So we're using this table here. We revert back to the reported EBIT rather than just the adjusted EBIT that we had been working with so far. So we're just simplifying a little bit of the calculation work going back in time, just so you can get a little efficient. And then, you've got some macroeconomic data, across those years. So you look at the T-bond rate, percentage changes in some key macro variables. Now this is a chart that would apply to any firm that's in existence over this particular time period that you want to do your analysis with. Now what we're doing here is we're trying to establish whether the firm value changes given particular macroeconomic adjustments. So here, of course, we're just asking how much would the firm value change for a given change in interest rates, right? And so this is a regression. Now these, just so you note, these kinds of regressions tend to be pretty noisy, even when there's a real long history to a firm. Often what you'll see is an analyst looking at, rather than on a firm basis, you might do it by looking at industry average coefficients, which probably are a little bit more reliable. You know, the sector betas are a little better than the firm-specific betas, as an example here. But here, we're doing it on Disney. And you can see the coefficient negative 2.3251 indicates how much the value of Disney changes with a given change in interest rates. The t-statistics indicate we've got pretty good intercept term, but note the t-value on the coefficient for the slope indicates that it's not really a significant slope, and that's going to tend to happen too. Again, this is in the case of a particular firm, so that's pretty common. So this is what's known as the Macaulay duration. It's a measure of the percentage change in the bond price for a 1% change in interest rates. So you can view this as the maturity of a zero coupon bond having sensitivity to interest rate changes. So again, it's looking at a particular financial concept, seeing how it is embodied in an actually existing instrument, and trying to port that calculation work over to our new way of trying to deploy a valuation question. So in the regression on the previous page, the coefficient on the change in the interest rates measures the percentage change in the firm value for a 1% change in the interest rates, and thus we can utilize this regression coefficient to help us get a measurement of duration. Okay? As you can calculate maturities with this Macaulay methodology. So you got a lot of approaches to this. It's really difficult to estimate the Macaulay duration on a project-by-project basis across the many firms, the many projects that the firms carry. So it's a lot easier to run a regression, but you get really noisy results because the way the firm will have adjusted its business mix over time. So you either go with just the basic intuitive analysis from the preceding, or possibly utilize industry average durations, because you're presuming that the kinds of capital projects in an industry would tend to be similar across firms, and that's potentially legitimate to do. Okay, so you're trying to get a sense of the interest rate influence, and just varying approaches. You could try both to see which one seems to be a little more digestible. You're going to have to vet it and justify it, of course. So we regress our changes in operating cash flows against the interest rates as well. A little bit better regressions. You got a slightly better coefficient here, and you know the firm value, remember, is affected by cash flows, but also remember it's affected by any change in the discount rates. Right? When interest rates increase, the discount rates also tend to go up, so that's going to have an impact on the firm value. All right, now I'm going to continue going because I'm going to try to build a few larger presentations here as we plug away. So let's look at, again, the question of the firm's sensitivity to changes in the macro variables, just looking at GDP or income. So the idea here is that our question, is this a firm that's cyclical? Right, the cyclical firm should have an operating income that moves along with the whole economy. Now, value might not move, right, because markets can look past the business cycle. So in this case, an operating income regression is a little bit more of a valuable resource. So the change in firm value depended upon a GDP variation. You can see Disney here is over time becoming more cyclical. In past iterations doing this analysis, Disney wasn't very sensitive at all to economic growth and economic, macroeconomic variables fluctuating. But it could be that Disney, because it's gotten more dependent on broadcasting, it's becoming a little more of a cyclical business. Advertising tends to be cyclical. Advertising revenue from broadcasting, therefore, is going to have an impact on Disney's overall value as a firm, rather than movies. Sensitivity to currency. Here, you're assuming the historical exposure of the earnings and the firm value to the currencies is going to be a pretty good measure of a future exposure. If there's some kind of really dramatic change in the firm's global structure, you might become a little less confident in this kind of analysis. But Disney's worldwide, has been worldwide for a long time. So these regressions indicate for us the negative effect of a strong dollar on Disney's operating income. That probably reflects the fact that Disney gets a lot of tourists to its theme parks. So when the dollar gets stronger, the tourists are less likely to visit the theme parks. And then you can see when the firm value goes down, right, you don't have as much of an effect. Let's do this inflation sensitivity. Remember, you got floating rate debt potentially, so the interest expenses are going to tend to increase when the market interest rates increase. And we're assuming year-to-year changes in interest rates are going to be the way we can proxy the, at least in the short run, again, year-to-year, adjustments in interest rates tend to occur because of changes in inflation. So what we'll see is regression results on Disney. Again, what you got is operating income tending to move with inflation, and the firm value not really moving that much, right? That's not surprising, right? The cash flow effects and the discount rate effects are canceling out in this kind of a situation. So which of these would you want to look at, maybe put a little more weight on? You should probably weigh the operating income regression more in terms of whether you want to use a floating rate or fixed rate debt. And that's because, right, some of your cash flows are going towards paying your coupons. Right? So the operating cash flows are really key. So if you look at all of those together, this summarizes these regressions, and you got a caveat. Most of these regressions do have low R-squares, and of course that also indicates if you go back tracking through these, you see pretty low t-values on the regression coefficients, the slope terms. So the estimates could be wrong by a fairly large amount. Big standard errors are the signal there. So you of course tend to want to reduce that error. Again, maybe go to sector-wide averages for the better coefficients. Joel. If you do this across the business types, the standard errors on the regressions, right, are pretty high. So here you want to yield a little bit more precise estimates of each of the coefficients. Now what you do is you go into the bottom-up values and you run regressions for each business. So you run this on firms in a sector and average out the coefficients. And then once you have them, you attach the weights to those estimated coefficients. See our weights in our last column there. And all we're doing is then converting our numbers into some tangible recommendations. You want longer term debt. Probably want a little more floating rate debt. You know that Disney's pretty sensitive to a strong dollar, so weigh some of the debt in terms of foreign currency. And if you looked at 2013 numbers, about 18% of its debt should be foreign, based upon the way operational revenues arise. Now, if you look at Disney's current debt, you probably have a mismatch, and this is really common. Most firms are mismatched a bit. You know, their existing debt structure, remember, is a result of history, and also there's some inertia that's kind of captured on the debt side. And Disney's business mix has changed significantly in the last decade. You have more broadcasting and less theme parks. So it's probably not a surprise that the debt structure didn't keep pace here. You also have sometimes market frictions and other limitations that create a mismatch. And if you looked at companies in emerging markets, they tend not to be able to borrow in the long term unless they really have good relations with banks. And in those markets, though, most banks won't lend long term, right? So that's going to be an issue. So Disney's large size, and it has ready access to capital markets, right? It's got lots of options. Remember that small firms and emerging market firms have fewer options. In an extreme scenario, of course, it's going to take time to adjust debt. So Disney is sort of an easy case to analyze. If you did Bookscape and Vale, and keep this in mind, we're not going to try to assess Deutsche Bank, right? What amount of debt it should have, because its assets are actually constantly changing, and debt, remember, plays a far different role at the bank. Right? It's raw material rather than a source of capital investment. So you've got this New York bookstore. Make it have long-term dollar-denominated fixed-rate debt. Vale has mines everywhere. It needs long-term dollar-denominated debt. You want to try to tie that debt to commodity prices because of the way that the cash flows are going to fluctuate. And here, we can see the actual versus the recommended type of debt. And if you look at Tata and Baidu, pretty straightforward here. Baidu's a young tech company, so very little debt exists there. And that's going to go up now because we're now going to switch to dividend policy. So let me save and convert this for everybody. And God bless.